Hello again, everyone. This is Gene Ahrensberg coming to you on Sunday, March 17th, 2013. This week, gold finished up about $13 to a $15.90 handle. Silver dipped 14 cents to $28.74 on the cash market, and mining shares ended mostly green for a change, light green. Today, I want to call attention to a wildly imbalanced condition which has developed in the Commodity Futures Trading Commission Commitments of Traders reports for gold. This week we saw trading for gold constrained into a tight, slightly rising range. And while we're looking at this chart, notice two very important features. First of all, there's no question that as gold attempted to thrust up to a $1,600 handle, it met with determined resistance. Equally important, though, notice that there are two sell rates showing in this chart with the same result. Both were immediately bought heavily, stuffed, and reversed. From that, we can clearly see the battle lines for gold. Roughly the 1560s on the low side and 1600s, or rather 1600 on the upside. That's if we use last Friday's low print for support. For the calendar week, a good case can be made that support has actually edged higher to the 1570s, and we're not going to quibble with those who would contend that. Before we leave this chart, let's point to where this week's COT reports cut off, and note that it was very near the high for the COT trading week. Today, we want to focus on the CFTC Disaggregated Commitments of Traders report. Each week, usually on Friday, the CFTC releases the reported positioning of the largest traders of futures on the COMEX Bourse in New York. The CFTC requires all futures traders who hold over a certain number of contracts to report their closing, long, short, and spreading positions as of the end of trading the previous Tuesday, in this case Tuesday, March 12th. There are penalties and sanctions for traders who fail to comply with the reporting requirements. As most of you already know, a long position benefits if prices rise, a short position benefits if prices fall, and spreading trades are simultaneous contracts in different contract months that seek to capture either a contraction or a widening of the difference or spread between the futures prices of those contracts. Most of what we talk about is net of spreading trades because they don't factor into the trader's net long or short positioning at all. Analysts who track the COT collect and analyze the COT data. This is the raw data we use each week. From that raw data, we can build charts to help us see what's going on visually. Over time, if diligent, an analyst can gain a sense of the changes in large trader positioning, and we can compare that positioning today to periods in the past. And from that, we can get an understanding of the personality of the COT and use that data and analysis to inform our own impressions. Perhaps most importantly, gaining an understanding of the COT personality, we can learn when the large trader positioning has reached levels that are excessive or anomalous. Then we can use that analysis to help us in our own trading. This is one of the charts we use at Got Gold Report and share with our subscribers. Each week, we comment about the changes in COT positioning and our own sense of what it means vis-a-vis our own short-term trading. And right now, in March of 2013, the COT has reached a historic imbalance in the positioning of the large traders. The COT is signaling that the trading in gold futures could get explosive just ahead. What I'd like to do with this video is to run through this week's subscriber comment and show the actual charts, both to give the comments context and as a kind of instructive exercise for subscribers. So let's get started. It'll go pretty quickly, so remember you can pause the video at any point to give it further study. We said in this week's disaggregated COT comments, or DCOT, that, and I'm quoting myself here, that the DCOT was strange this week, as the only class of traders on the net selling side this week was swap dealers, net sellers of 12,843 lots, with all others net buyers, unquote. Then the comment continued, quoting, producer merchants, including bullion banks, covered or offset 4,520 lots to show a very low 95,242 contracts net short, the lowest since December the 9th, 2008. And we are looking at the chart for the producer merchants. And who are the producer merchants? They are the natural hedgers, the people in the business who literally have to hedge their exposure to a falling gold price. This category includes the producers of gold, the miners, and the people they sell to, the largest dealers of bullion, the refiners they buy from. It also includes the jewelry manufacturers who have gold inventory or gold on the way to them from a producer or refiner, and on, all the people in the gold trade, plus the bullion banks that many of these traders end up trading through, because the bullion banks make a market in gold, in the physical market, and in futures. In short, the producer merchants are considered the largest, best funded, and because they make markets for much of the gold trade worldwide, they're considered the best informed traders of gold and gold futures on the planet. And what do we see in their current positioning right now? First, since their net positioning is a negative number, because the hedgers are always net short, the higher that blue line goes means a lower net hedge position, fewer net short bets. And as of the close on March 12th, with gold then at $1,592, the smartest, best funded, and presumably the best informed traders of gold futures are at their least net short position since December of 2008, during the heat of the 2008 panic, when gold had been sold off to around $700 in a rush to liquidity. Then, in other words, the producer merchants are the least worried that gold will fall further in price since the 2008 panic. Our next comment was, and I'm quoting, "Managed money traders increased their net longs by 3,154 lots, and here we can see that in the DCOT recap. And here we see the managed money net futures positioning graph. Managed money are trend following traders, hedge funds, commodity trading advisors, people who operate commodity pools, and other large traders who trade futures on behalf of clients. Sometimes we just shorten all that and say the funds. And what is very apparent looking at this graph of the funds positioning is that as of March 12th, the trend following funds are reporting near their lowest net long positioning since the 2008 panic. Now, this net position graph kind of makes it look like the funds have been selling off their long gold contracts, but anyone who thinks that would be wrong to think so. As anyone can see, the funds have not really been selling off their long gold contracts over the past 7 reporting weeks, and, in fact, their longs actually increased this week. Instead, they have been adding shorts as gold has been falling from near $1,750 in November. Ironically, it has been the funds putting a majority of the selling pressure on gold futures, causing them to put on even more insurance shorts, which added to the selling pressure. Let's continue that comment on the subscriber chart. Remember, the comment started with, "Managed money traders increased their net longs by 3,154 lots," and then continued to say, and I'm quoting, "but did so as they also increased gross shorts by 1,460 to a new record high 68,642 gross shorts." This is the graph for just the managed money short positions. And look at that. The funds have built up an insurance short position of a whopping 68,642 contracts. And that does not include options, just futures. That's the reason their net long position is at such a low level, not because they've been dumping their long contracts. For perspective, the previous record high managed money short position was on September 16, 2008, the week we learned Lehman Brothers was going bust and fears of a global banking collapse escalated. Back then, the funds had put on 43,587 insurance shorts, with gold then in the 770s. So today, managed money traders have an insurance short position 25,055 contracts, or 57% higher than when Lehman was going down. But they put on those insurance shorts while mostly keeping their long contracts. So we have the managed money traders adding 3,154 net longs while also adding 1,460 shorts this week, which sets up our next comment in parenthesis. Tells us not all the MMs managed money on the same page with the 54 managed money traders reporting shorts. They may break ranks on a gold surge, unquote. That should be self-explanatory, but to emphasize our view again, important lows in the managed money net long position, like right now, have corresponded with important turning lows in the price of gold in the recent past, as we show here. Our comment this week continued, quoting, "Other reportables, very large traders, trading their own book, add another 3,766 to another new record high 70,183 lots net long," unquote. Here we can see that record high net long position for traders the CFTC classes as other reportables. The other reportables class is the group that catches all the very large traders who don't fall into the other reporting groups. In general, we believe that the other reportables are very large traders who trade futures for their own book, not for clients. And right now, the other reportables hold the largest ever net long position for gold futures since the DCOT data began in 2006. With that, let's look at the summary sentence in the weekly gold chart. We said, the COT is strongly contrary bullish, with producer merchants at their least number of hedges since the 2008 panic, while other reportables are record net long, with managed money the least net long since 2008, and while managed money is record spec short, with swap dealers the only net seller this COT week, leading us to conclude that the COT is very imbalanced and thus dangerous for both sides of the contest. Having said that, the COT is the most contrary bullish we have seen it since December of 2008. It would not take very much of a catalyst to send gold into the region which would begin massive spec short covering. And here on the daily gold chart, we show a green oval at where we would guess that heavy, urgent short covering might kick in. It's just an educated guess, of course, but with the funds having such a high gross short position, we know to a certainty they don't have the metal to deliver into those shorts, and therefore we know they will be covering them. It's a sure bet that at some level the funds will be in a hurry to buy back those short contracts, and if the New York locals and smaller traders sense that the funds are covering, we might expect them to front run the managed money short covering, which would mean a lot of buying pressure coming in all at once, and that, friends and fellow vultures, could mean an explosive rally. I hope that going through this week's DCOT comment gives all of you an appreciation for what goes into the weekly comments in the GGR subscriber charts, and perhaps an appreciation for just how very unusual and imbalanced the COT has become in this pullback for gold. The COT is just one of the indicators we review each week at Got Gold Report, but it is perhaps the most important one at times. No one can see the future. Nobody really knows what the price of gold is about to do for a certainty. But by tracking and understanding what the largest, best funded, and best informed traders of gold futures, we can gain insight into how those large traders are positioning in their own best interests, and from that we gain confidence in our own trading. Right now the COT is the most bullish in a contrary sense we've seen it since December of 2008. That does not mean that gold is heading higher for sure, but it does mean that the stage is set for, as Don Cox recently said, for the biggest gall-darn gold rally ever coming. I suppose the question is, from what level that gall-darn rally will get started from. That's all we have for you today. Thanks for watching, and we'll see you all again next time. Bye for now.